There are two core price action trading concepts that, when combined, form one of my personal favorite entry models. These concepts are so powerful that they actually make up the backbone of most of my trading strategy. They are liquidity and market structure. In this class, I want to give you a deep understanding of both, and I'll also share with you an entry model and a trading system that you can start applying right away to make better trades and, yes, real profits. So, let's dive in. Market structure theory is simple but incredibly powerful. It says that markets move in three phases: uptrend, downtrends, consolidation, sideways movement, where trading opportunities are limited. Let's break it down. In an uptrend, we're only interested in buying. Why? Because the market is making higher highs and higher lows. Every new high is above the previous high, and every new low is above the previous low. When the market pushes past a previous high, we call that a break of structure, boss, and it tells us the uptrend is continuing. A downtrend is basically the opposite. Here, the market is making lower lows and lower highs. Every low is lower than the one before, every high is lower than the one before, and when the market pushes past a previous low, that's your break of structure, confirming the downtrend. Every trend is made up of two main types of movements. Impulsive moves. These are the pro-trend movements. They break structure and drive the trend forward. Corrective moves. These are small pullbacks. They don't break structure, but they form new highs or lows to help us understand where the market is going next. Here's how it looks in an uptrend. The market makes a higher high, impulse. Then it pulls back slightly to form a higher low correction. Then the market pushes up again, breaking the previous high and forming a new higher high, impulse. And the same idea works flipped for a downtrend. Lower lows, lower highs, impulsive downward moves, and corrective pullbacks. Trends don't last forever. How do we spot when an uptrend is ending? Look at the higher lows. If the market breaks below a higher low, this is a bearish impulse. It signals the end of the uptrend. From here on, we'd expect a lower high, a new lower low. Continued lower highs and lower lows. This is how the market shifts from a bullish trend into a bearish trend. This is the backbone of my trading strategy. Understanding structure, spotting liquidity, and knowing where the trend is likely heading. Master this, and you've got a system you can rely on. So, liquidity is basically all about orders and money moving around in the market. Markets don't just move randomly. They move because people are buying, selling, and transactions are happening. That's what drives price action. To really understand liquidity, think about where people are buying and selling from. Imagine a trending market. We've got a swing low and a swing high already formed. Naturally, buyers cluster near the low and sellers cluster near the high. That's just how most traders operate. Here's the key. Traders usually buy above lows and sell below highs. Anyone buying near a swing low typically sets a stop loss just below that low. Sellers do the opposite. Stop loss just above the swing high. Rarely do stops sit randomly in the middle of a trend. They're almost always around these highs and lows. So, what does this mean? Those highs and lows become liquidity zones. Why? Because tons of orders are sitting there. Stop losses, breakout orders, you name it. Think about it like this. Under a swing low, buy stop losses from people who bought the low sell stop orders from breakout traders hoping the market drops through the low. At the swing high, stop losses from sellers. Buy stops from breakout traders hoping for a new high. That's thousands of orders waiting to trigger. And since markets react to orders, the most likely places for big moves aren't in the middle of a trend. They're at these highs and lows. Hit the swing high, you might see a strong sell. Hit the swing low, you might see a strong buy. That's liquidity in action. Let's look at an example. Say we have a bearish impulse, followed by two highs that are level with each other and two or three lows also level. From a support and resistance perspective, traders do this. Buy above support, hoping price moves higher. Sell below resistance, hoping price moves lower. This creates stop losses above resistance, stop losses below support. Buy-sell stops from breakout traders. So again, liquidity clusters around key levels, not in the middle of the range. Now, what do we do with this as traders? Two main things. Targets. Knowing where liquidity sits gives us potential targets. If the market sweeps a low and then reverses, we can go long toward the swing high, because the market is likely coming back to attack that liquidity. Entry opportunities. Once a low or high has been swept, we can look for trades in the opposite direction. Example, if the market moves up to a swing high and hits liquidity below, we can look for a structural change, like higher highs turning into lower highs, to sell and target the next liquidity zone. Basically, understanding liquidity means we're not just guessing. We're strategically planning trades around where orders actually sit in the market. That's how you start forming real trading setups. I'm going to show you a simple but powerful entry model that combines structure and liquidity. Don't worry, we'll break it down step by step so it's super easy to follow. Imagine we're in a bearish market. What do we see? The market is making lower lows and lower highs. Classic downtrend. Between those big moves, there are small corrective pullbacks, tiny pauses before the market continues down. These little pullbacks, that's exactly what we'll focus on. Think of liquidity as areas where stop losses or buy stops are sitting. Usually this happens at equal highs or resistance levels. Anytime we spot a resistance forming, we know there's a bunch of orders waiting above it. That's our target. Sometimes these equal highs appear inside a bearish move. When that happens, it's like a jackpot, a high probability setup. Watch the market break the equal highs or hit that resistance. When it does, it's moving right into the zone we want. Here's the final trick. Look for a supply zone, a level where significant selling happened before. When the market comes back to this zone, it acts like a magnet for sellers. This is the premium price area to enter a sell. Bearish trend, lower lows and lower highs. Spot equal highs/resistance liquidity. Wait for the market to reach that liquidity. Enter the sell at the supply zone, where sellers have historically stepped in. Now this works on any time frame. And don't worry if it feels a bit confusing right now. You'll see it in action on real charts in just a moment. You might be thinking, wait, isn't this a break of structure? Shouldn't we be looking for buys instead? Here's the key. It all comes down to how the market reacts to liquidity. If there weren't any equal highs or resistance, yes, that would be a real break and we'd look to buy. But because there is resistance and liquidity above, this break is actually likely to fail. Why? The market just needs to sweep the stop losses above those equal highs before continuing the bearish trend. This is called a false break of structure. Basically, the market tricks traders into thinking it's reversing, but it's really just gathering orders before dropping again. How to tell the difference? Ask yourself, do we have significant liquidity above, like equal highs or strong resistance? If yes, it's probably a false break and a high probability sell setup. All right, let's bring this to life with an example on the chart. So check this out. We've got a strong upward move. Price pushes up, forms a higher high, then pulls back for a higher low, pushes up again to make a new higher high. After that, another higher low, another higher high, and then, boom, we get a break in structure. Now what does that tell us? Simple, the market just shifted. We moved from a bullish structure into a bearish one. The higher highs and higher lows have flipped, and now price is making lower lows. That's our confirmation that a bearish trend has kicked in. From here, we mark out the high and the low of this new bearish leg. Price pulls back to form a lower high, then drops down into a lower low. But notice this messy little zone in between? Price just moves sideways, doesn't really go anywhere. That's consolidation. And here's the thing, we don't want to be trading inside these consolidations. Why? Because the market is literally pausing. It's not trending, it's just ranging. It's only once price breaks out of that consolidation and pushes into a new low that the bearish trend continues cleanly. Now let's zoom in on that consolidation. What usually forms here? Equal highs. And that's exactly what we see. The market pushes up once, twice, and then a few smaller pushes around the same level. That gives us a clear resistance zone. Here's why that matters. Buyers are placing stop orders above that resistance, waiting for a breakout. Sellers are also stacking in this zone, placing stops just above the equal highs. So what do we get? A pocket of liquidity. Lots of trapped orders sitting right above those equal highs. If price sweeps this level, it grabs liquidity and then continues lower. Now let's add one more piece to the puzzle, the supply zone. Remember what we said? A supply zone is just a consolidation area before a big bearish move. And right here, we've got a perfect example. Look at that candle with the big wick. Price opened and closed almost at the same spot. That's our last candle before the bearish impulse that broke structure. That's our supply. So now we've got everything lined up. A bearish trend. Equal highs inside that bearish trend. A supply zone just above those equal highs. Here's how the model plays out. Price sweeps the equal highs, taps into the supply zone, and then sells off. That's our entry model. So how do we trade it? Simple. Place a sell limit at supply. Put your stop loss just above the high, safer than just above supply because price can wick. Set your targets at areas of demand or liquidity below, like previous swing lows or consolidations before upward moves. For example, in this case, we could target the demand zone formed at the bottom of the chart. That way, the trade has a clean path to run. This setup gave around a 4.6 R trade. That's 4.6% profit for every 1% risked. Beautiful, right? And by the way, this model isn't just for selling. If the trend flipped bullish, you'd do the same thing with equal lows and demand zones. Exact same logic, just inverted. So that's the entry model. Bearish impulses, equal highs, liquidity sweep, sell from supply, and target lower. Or flip it around for bullish setups with equal lows and demand. I hope this breakdown gave you clarity and confidence in analyzing the charts. If you found value in this, make sure to like, share, and subscribe. I'll keep bringing you more practical, no-fluff trading lessons. And when you start trading like that, everything changes. I hope you liked this video. Don't forget to comment on what topic I should cover next. See you!